They call interest rates a technical adjustment, a small move, half a point, maybe a quarter. But that small move can decide who keeps their home, which companies survive, and whether an entire economy slows down on purpose. That's the part they don't lead with. Right now, interest rates matter more than almost any other economic force because the world is carrying more debt than it ever has, and the price of that debt just changed. Here's why this isn't just about inflation or growth. It's about a quiet power struggle over who absorbs the pain when the system tightens. At the center of this story is a group that prefers not to be noticed: central banks. They don't campaign. They don't run ads. They speak in carefully neutral sentences and release statements that sound like they were designed to put you to sleep. That's not an accident, because central banks control the price of money, and whoever controls the price of money controls the flow of the economy. When interest rates go up, borrowing becomes harder, mortgages get more expensive, business loans slow, hiring freezes, asset prices fall. When rates go down, the opposite happens. Debt feels lighter, investment speeds up, speculation creeps back in. On paper, the job is simple: fight inflation when prices rise, support growth when the economy weakens. But the real world isn't that clean. Start with inflation. Inflation isn't just higher prices, it's money losing credibility. It's the system admitting that too much debt or money was created relative to real output. When inflation rises, central banks are expected to raise rates. That's the rule. That's the promise. But raising rates doesn't hurt everyone the same way. If you have cash, higher rates are annoying but manageable. If you own assets, you adjust. If you're heavily in debt, rates are existential. Households with variable mortgages feel it first. Small businesses with floating loans feel it next. Governments feel it last, but at scale. And this is where the tension starts. Modern governments are the largest borrowers on Earth. They refinance constantly. They roll debt forward instead of paying it down. A 1% increase in rates doesn't sound dramatic, but for a heavily indebted government, that can mean billions more in annual interest payments. Money that doesn't go to public services, money that goes straight to creditors. So while central banks talk about independence, political pressure is always in the room, quiet, persistent, unspoken. Banks add another layer. They don't want rates too high, defaults rise. They don't want rates too low, profits shrink. Investors want predictability and ideally protection when things break. Workers want jobs and stable prices. Those two goals often pull rates in opposite directions. So when a central bank sets interest rates, it's not choosing a number, it's choosing which group absorbs the shock. Here's the uncomfortable mechanism most people never see. Central banks don't just react to inflation, they react to financial stability. If inflation is high but markets look fragile, rate hikes slow down. If inflation is cooling but asset bubbles look dangerous, tightening continues. Markets aren't just reacting to policy. Policy is reacting to markets. That feedback loop is never advertised, but it explains why decisions often feel inconsistent. Publicly, rate decisions are framed as data-driven. Privately, they're about preventing the financial system from snapping. And sometimes that means protecting the system at the expense of the public. You've seen this movie before. Years of cheap money. Debt builds quietly. Assets rise faster than reality. Warnings get ignored. Then inflation appears. Rates rise. Something breaks. When it does, the response isn't moral, it's practical. Emergency lending, liquidity support, quiet rescues. Rates go up to discipline inflation. Rates go down to save the system. Discipline is widely shared. Rescue is selective. Zoom out globally and the stakes climb higher. When major economies raise rates, capital flows back home. Emerging markets suffer. Currencies weaken. Debt becomes harder to service. A decision made to manage domestic inflation can destabilize entire regions. No vote, no debate. This is why interest rates are geopolitical. They move capital, shift power, and expose weaknesses across borders. Yet the public conversation stays small. Is inflation coming down? Will there be another hike? That's the surface story. The deeper reality is simpler and harsher. Interest rates decide whose mistakes are tolerated, whose debt is survivable, whose pain is delayed, and whose is immediate. Right now, the system is boxed in. Debt is high, populations are aging, productivity growth is slowing, political patience
Yes,
is thin.
but we
Rates can't stay
must
high forever. They can't
account
stay
for
low forever either. Every path forward
variables.
hurts someone. The next
Agreed.
interest rate decision will be
Let's
presented as technical,
adjust the
measured, responsible. But
models.
behind that calm announcement is the same unresolved question modern finance keeps circling. In a world built on debt, who is supposed to pay when the bill finally comes due?